joining us on this debate. I'm pretty determined to poke each and every one of my panelists with views and insights that are really controversial. So let me start by saying a little bit about my background, which is quite controversial. I did start a very traditional Wall Street career in the 90s in Manhattan, so I do come from the Wall Street world. But I have converted into the fintech world the last 6-7 years. I'm an influencer and an advisor. You should follow me on social media, Efi PM, and on anything that you can get your hands on. And I do come from Switzerland, where I'm working, so from the heart of Crypto Valley, a lot of influence around the blockchain ecosystem. And in general, I have strong views around what banking should be and the topics around platforms. So let me set the scene before we start our debate. I call our life the life that is lived within an attention economy, and that definitely is being set by the big tech firms. Our social behavior has been impacted whether we like it or not, or whether we realize it or not. The other fact is that there's a huge disconnect between financial services and this attention economy. So we are going to be talking about that, whether we're going to see convergence, whether one is going to steal the business from another, the big tech firms, or some super app FinServe sort of platform that may be coming up. So that's the core of our discussion. To remind ourselves, everybody today, as an end customer, is expecting 24/7 service, personalized, contextualized, and so on. So that is the battle that is going on within fintechs, and I don't think that blockchain is sort of disagreeing or competing with that concept. So bringing that sort of setting of the scene, I think that blockchain fits into this picture in terms of challenging the non-transparency that the traditional financial services sector has had, the proprietary attitude and so on. And then we have the new fintechs that are commoditizing services, but in my opinion, haven't really done very much in terms of actual transparency and culture, and that's where a blockchain probably can fit in. So why don't I start by introducing you and asking your point of view as to what the debate should be in terms of, customers and big tech and platforms and so on. So I will start with you, ChristyAna, on my right. Tell us about yourself, how you're involved in the space, and about Act Ventures,
yes.
Which is your company.
Yes, so ChristyAna, I'm from New York originally, and have been out in Puerto Rico for quite a few years. So I'm representing two companies. One is Act Ventures, and we do investment consulting, mainly for projects to funds and deal flow. And then my other function is with Wonder Venture Lab, and this is a tech design platform. So we do mostly enterprise solutions and consulting to how not just blockchain, but incorporating emerging technologies within enterprise.
Great, thank you. Chris Sier, you are with the UK Treasury FinTech Envoy.
Yeah, it's got me down as clear glass there. No, I'm the Treasury's FinTech Envoy, so I do kind of outreach on behalf of the UK internationally to discuss the UK as a destination for inbound companies. And I do the opposite, which is I help UK companies figure out what the landscape is to sell their products and services internationally. That's a vocational role, but it's a title, no more than that, which means I get to say controversial things without having to toe the party line too much and to get involved in interesting things. My interest principally in this space started, and I'm glad we've got an Estonian in the audience here. My wife is Estonian, so I first started thinking about digital identity and the use of distributed ledger blockchain in that capacity. Oh, crikey. I mean, that whole framework's been around for almost 20 years in Estonia. So I always envied it. I got involved with the Estonian Digital Service, became an advisor to them for some time, and tried for some time to get the UK government to consider a similar framework for digital identity before, frankly, just giving up because it was so impossible. And in that moment, the paradigm for getting distributed ledger, blockchain, into a bank and into the financial services system is perfectly represented. It makes absolute sense. It is the answer to a lot of the problems, and yet it may never happen because there is an unwillingness by the institutions who are involved to change. Now, just one final thing before I kind of stop opining here. I come to learn over the past few years. I've done some work for the FCA. I chaired a board for the FCA until about a year and a half ago, to do with looking at the asset management industry. And part of the reason why the asset management industry was being scrutinized was because they were suffering from an overt lack of trust as a result of transparency, a lack of transparency. And I always thought that the reason why big tech should enter this space was because they were more trusted than the incumbents. People look at financial services now and they consider it to be untrustworthy. You buy on the basis of trust, you give your money to someone on the basis of trust, and frankly, big tech blew it with Cambridge Analytica. So they had a huge competitive advantage right up to the point that they were deemed to be as untrustworthy as the organizations that they had the potential to reproduce. So I see it now as a level playing field again.
Helen.
Yeah, Chris makes me think. He always makes me think. So, like Efi, I started my career in Wall Street, so I'm a reformed banker, different kind, commercial banker. And then I went on a journey where I was helping lots of companies to raise finance, and that's how I came into the fintech space, because you remember in 2012, 2014, when they were looking for SME clients, which I had, and also to raise money, it was like the perfect storm before I went off to Innovate Finance, where everybody was talking about Brexit and blockchain at the time. In moving on from there into rainmaking, this was, you might know Startup Bootcamp as some of it. That's where we were looking at, well, can we incorporate this? Should we have a blockchain stream in an accelerator or in a scale-up accelerator? Is this something that we should be doing? Because the banks were telling us, incumbents were telling us that this is what they wanted to explore, particularly around, for example, asset finance, where it would sit well. But the reality is, as Chris alluded to, is that they don't really have what it takes to make that step necessarily now, where you can see lots of applications for it. My work with rainmaking took me to the Middle East, where you have more of an emerging market, lots of people who are, they are working from other countries. You haven't got legacy technology. It's a perfect bed for this to be made in with the new technology, and you have an openness to the acceptance of it. So working in the Middle East, working in Africa, this is where I've actually seen more of the application possibility. And I agree with you about Cambridge Analytica, and I agree with you about trust, but I think also that the banks, there's a weird thing about incumbents with trust. People don't like their bank, but there is an element of my money is safe in that place. And you need courageous leaders to step out and gain the trust back, and I'm not sure we have them.
Thank you, Helen. Mohammed?
Yes, first of all, I've been replaced with Mr. Gustav, I think not because of the coronavirus, I guess. But anyways, I'm Mohammed Salman, Managing Director of Aventis Tech. Also being into the space of fintech as PwC's trainer and designer for their training courses. And we have an accelerator program acting upon the government side of the blockchain implementation. Regarding this narrative, I think the narrative going forward is hybrid. It's big tech along with the startups. That's what we have been observing in the Middle East, because I'm based there. We have our the network ecosystem is like, yes, there is IBM's role for the IBM, but at the same time, there are a lot of startups bringing in a lot of value into the ecosystem. Same goes with the fintech side. It's like not getting into the tech fin. Still, it's a fintech in Middle East. So primarily, people are seeing it as a financial-based technology, like add-ons, but in some areas there is like a change. It's becoming technology first, and then it's a finance. So for me, it's the narrative of this debate is that it's a hybrid future we are seeing, at least for the next 5 to 10 years.
So let's start with what's happening now. I mean, we've been seeing big partnerships between big tech companies and financial services providers. The most sort of obvious big example is Goldman Sachs with Apple, with their card, and then Goldman is also set a partnership with Amazon for lending to their SMEs, their merchants. So what do you think? Is this the beginning of really the incumbents becoming dumb pipes and everything becoming BaaS, banking as a service, so to speak? And at the same time, I want to ask you why you think that the Cambridge Analytica Facebook debacle has also damaged the other big tech, the other FANGs, if you want. Has it damaged? Has it blocked that sort of possibility of BaaS everywhere on the fintechs?
Do you want,
no.
I was just going to say, I think one thing to keep in mind with the Cambridge Analytica thing, although we both mentioned it, is memories are short. You know, when I'm lecturing and I teach at the master's course at UCL and Imperial, and I ask people, do you mind being hacked? Do you mind if your details? We kind of expect it. At a certain age, people kind of expect it, and everyone just kind of gets on with it. It's happened to me 5 times in 1 year, right? But memories, and I didn't give my password away. I wasn't hypnotized, I promise. Memory is short when it comes to these things. So how long will people remember this, or just say, well, it was what it was part of the growth of it, and so, you know, let it go. But it gave incumbents one more opportunity. The door was open a little bit because they need to move. It's not like the opportunity, right? With open banking, for example, we talk about, well, there were going to be dumb pipes. There wasn't competition. They didn't want to share their data. It wasn't going both ways. They just don't move. They need to move more quickly.
I think for me the issue is, I mean, I had a phone call today from Fund Forum, one of the big conferencing organizations in the fund space, to say, yeah, we noticed that you were looking at our website and we wanted to know if you wanted to buy a ticket. And I hit the effing roof. I mean, I'm sorry, that to me, and I said, how the hell did you get my number? And how the hell did you, why did you contact me? Now, it so happens I've spoken at Fund Forum half a dozen times in the past decade. I'm kind of well known in that circle, but this was an unacceptable use of, and every time something like that happens, and it happens, you hear of the examples where you're talking in front of Alexa, and the next thing you know on Amazon, the thing you were talking about pops up. You are searching, you get a constant reminder that A, they have an intrusive appetite for everything about you, and that breaks my trust immediately. And the second thing is, I don't like being sold to. And the big tech is used to selling. It's used to taking your data, doing what it likes with it, and it's used to selling. And whatever happens with the banks, they're terrible at selling. I mean, they're terrible at selling, but at least they don't sell to me, and they don't really abuse my data. They may abuse my money, but I feel removed from my money. It's very personal to me when something I'm thinking about and looking at suddenly pops up in my browser. It frustrates me. It may be different for a different generation. It may be different for different people, but I hate being sold to. Really hate it. And so if they started popping up, if the pop-up started coming on saying, would you like to use, you know, Apple Pay, or we've got a new payment platform, or we've got a new product, I would not use them by default. I would stick with my old bank and I wouldn't touch them.
So you dislike the push model?
The push model is how they make money.
Right.
And it doesn't work with financial services.
Well, I think, yeah. I mean, I'm happy about Cambridge Analytica and that it's exposed, right? So
correct, yeah.
I go and visit my nephews, and in the commercials they're like, Auntie, you want to buy that? Auntie, let's go eat there. Auntie, you want that? You want to get a little troll? You know, so there's all these things. We're just trying to watch, you know, Puppy Dog Pals, and then all these commercials are telling my nephews what I want, what they want to eat. So we're being sold constantly, and we don't even know that, right? Or it's just subliminal. It's happening all over with everything that's happening.
It's a really interesting point because, so for me, one of the key players in this is the regulator. And the regulator is, if you want to play in the banking space or indeed any of the financial services space, you must be regulated. So if you're a fintech startup and you're going to be doing anything which is relating to advice or selling products to the consumer, if you don't go through the FCA, they're going to shut you down. And the same pretty much exists in every single, and as soon as someone pushes you a product, it's a form of selling. So if the fundamental model of the big tech platforms is to constantly push you stuff, they are falling right in the middle of something that has to be regulated.
That's a great point, Chris. I mean, financial services have about 5 times more regulation than fintech. Do you think that we are going to be seeing a closing of that gap soon because of what is going on in the market, both because of data breaches, but also because of the BaaS models that I mentioned before that are hitting the market more and more? Do you think that that gap will close? And maybe in 2 years, that 5 times is only 2 times?
Well, come on, Helen, you can say something.
So the regulator here obviously is a principles-based versus a rules-based, doesn't come down hard. Somebody in a previous panel mentioned something about MAS in Singapore being quite open, although there is an underlying firm grip in MAS. It appears to be more open, I think.
Oh, you're in terrible trouble if you screw up.
Then it is, yeah. And I think from the tech point of view, why would you get a banking license if you can just buddy up with somebody and then while I'm in the real-time transaction, you just say to me, oh, you're here, Helene, why don't you have a loan? Or why don't you pay for, either side, as the purchaser, as the seller. If we believe that fintech, for example, really is, the goal is to become totally transparent, part of my everyday life, real time. I don't get up thinking I want to go to the bank to buy a car, but if I'm online and somebody shoves the money in my face, I want the money to buy the car because I want the car, not the banking transaction. Then this is kind of that, the end of that natural progression is I'm in real time and somebody is shoving me the finance option that they've negotiated with the bank as the tech company.
There's a real problem here in the way the regulator and the techs would behave. If you've ever worked for a bank or you've ever tried to put a new framework in for, the regulator or the Bank of England shouted at banks for failing to make loans to people during the financial crisis. And the reason was principally, we don't know when we're making a good loan versus a bad loan. Sure. And that was a data thing, but it was also if you make a bad loan or you give someone money that they shouldn't have, we're really going to dump on you. And that's always in the back of everyone's minds. There's also a reason why the regulator is so complicated around banks and regulating banks. And I want to expand this discussion if we can beyond banking, because banking is really the smallest part of the market. Long-term savings is the biggest. And there's been no activity in the long-term savings market, and that's where most of the impact can be found if we would look for it. But we'll focus on banking. I did a piece of work for the Bank of England with Oxford University about, 10 years ago now. And we put together some large agent models looking at and replicating the banking system. We had 2 principal models. One was, let's create a too big to fail model where you had a banking system that was composed of large nodes, 4 or 5 large nodes, and we'll get the machine operating, we'll run the marketplace, and then we'll make one of the nodes collapse and see what happens to the network. Guess what happened? The network collapsed. And then we replicated it with a network of many, a kind of a mesh distributed network of many, small nodes. And you take one away, and guess what? The network self-heals. There's no financial stability risk, there's no systemic risk, there's no contagion. And so the question is, why don't we regulate towards introducing more banks? It's what the challenger banks want to do, right? And the answer is because it's bloody hard to monitor a distributed network of small nodes. But it's very, easier from a regulatory point of view to have 5 or 6 and sit on them really, hard because you can control them. And if necessary, the government can buy 1, perhaps 2, which is exactly what happened in the UK. You can control it. And bear in mind, the job of a regulator in the Bank of England actually is to maintain control over the stability of the banking network. So I think there are some real tensions here that mean it's very, very hard, A, for challenger banks to start, but B, for organizations that survive based upon the principle of a distributed network of small nodes. That's distributed ledger in a nutshell.
Right.
Yeah? It's almost impossible for the regulator to conceive that as a way of pursuing financial services. There's a fundamental juxtaposition there that nobody has tackled. It's an existential thing.
Sienna?
Yeah, I mean, I'm right on with that because, excuse everyone working in challenger banks, but there's nothing revolutionary about challenger banks.
Yeah.
It's
Thank you.
just the customer service department is prettier. You know what I mean?
The front end is pretty.
The front end, yes, and I appreciate that. But the rails are the same. So why are they even in this discussion, you know?
Well, I mean, they basically commoditized the service,
Right.
Improved the user experience. It's what's also happened, for example, with robo-advisors, right? And culturally, there isn't a very big difference. That's the truth of the matter. And most of these businesses are not sustainable businesses standalone, right? Does anybody disagree on this?
What, a bank, you mean? Sustainable by itself?
Yeah, the challenger banks or the fintechs that have commoditized by improving the user experience, by reducing the costs and offering,
More touch points. I think.
Or they're being bought out. Plaid just got bought out by Visa. Or Corona's going to take half of them out as well, maybe next week.
Regardless of what size of bank you are, you have to hold regulatory capital. You have to report into the Bank of England. You've got to do all of this hoops to jump through. It's an enormous burden. It's an enormous burden. And I just don't think it makes it easy for banks and for small startups. But then again, I also think that perhaps it maybe shouldn't. There's part of me that says, well, actually the consumer would agree. How many challenger banks now are suffering from lack of customers because they're still sticking with Barclays, HSBC, Lloyds, RBS, because that's what they've always had. Customers are sticky. There's something instinctive about their need to stay with a really, really big brick institution. They want to put their money there. It feels safe. It's, you may have on the fringes of your finance suite of products that you use, the peer-to-peer world or the equity crowdfunding world. But fundamentally, you've got a pension fund, and it's with Scottish Widows. You're not going to put your £500,000 pension fund with a tiny company. You're going to keep it with Scottish Widows. You're going to keep your mortgage with Halifax, and you're going to keep your bank account mostly with RBS. But on the fringes, you maybe will have TransferWise.
Yeah, but if we shift our conversation from retail to SMEs and to capital markets, because, if you think of banking and disruption, that is where it would make a lot of sense to have true innovation.
Yeah.
So let's move away from retail financial services and talk about what we see in commercial banking and in capital markets. Where do we see, who owns the customer, so to speak, there? And do big tech firms and platforms have a role there? Because this is not low-hanging fruit, right? Like consumer banking.
This
What do we see there? Is it the case that banks, as we know them, or some grown-up fintech owns that market, and then retail is a different part, and it's sort of owned by the big tech firms?
Yes, coming from a Middle East, yes, the market is very much in the hands of the fintech at the moment when it comes to the commercial financial services. Payment gateways, hardly there is any known bank or incumbent coming forward bringing that service. Fort is one coming to my mind, which is a startup. I think 5 years back it was a startup. Now it's an established brand for the such things. Mnet in South Asia, so on and so forth. There are you rightly pointed out, the market is with the fintech at the moment, and incumbents are very much dependent. They are good with the trust, as our fellow panelists are saying, but they are not good with the technology. And technology is coming up with the goods every now and then. And so does the regulators. They are also falling behind in the learning the technologies improvements. So yes, this market is clearly with the fintech.
I think there's a faster learning curve there, right? Because you know, if we assume that oil is not the future, right? Data is the new oil in parts of the region. They've had to move very quickly, to attract people into the region, and go with the technology and align it, but also everything happens on the phone, right? And then when you have regulators in that part of the world who will say, well, if you have a digital bank account, you still have to go in person to prove your identity. This is also up for discussion now, so the regulators are moving much more quickly than we may have here, because there's other things happening in the region that are economic, that are also driving demographic, it's quite a young demographic, that are driving the change. Whereas if I sit back here and I think of some of the clients I had in the past who were looking at lending as a software solution, for example, right, when it's tied to asset finance, blockchain for me was the perfect solution for asset finance. When we started having the conversation about what the challenges were and what solutions might be, and we started talking about the cloud, and this was only 2 years ago, don't talk to me about the cloud unless it's a closed cloud, it's our cloud, we can't go on the cloud. Now everybody's on the cloud, right? There is a resistance to the technology that a fintech or a tech will adopt, because you can't go to the regulator and say, well, where are you storing that data? I don't know, it's in the cloud. Where's the cloud? I don't know, it's in the cloud. It's not in a room or 5 rooms in West London, for example. So how does the regulator catch up with that? And culturally, and as I mean in the culture of business, in an incumbent, there are lots of people who are my age plus, 12, no, who will retire soon. And the question is, do you want to rock the boat before you retire and bring something in? Or do you want to just ride out on your pension and just go into the sunset and not take that chance? I think most people know that I now deal with smaller banks where that is actually it could make or break the CEO of the bank. So there's a few things going around that are economic, demographic, cultural, and the tech.
Just to clarify a couple of things, thank you, and I think that's great. The example of the cloud is a good one and how it's been adopted. You conflated SME, the SME market, with capital markets. The two are different things. SME is commercial banking, capital markets is about capital markets. And actually, as soon as you hit capital markets, you hit my area of expertise. That's where I am strongest. So I spent some time as the CEO of a custody bank, which is one of the big participants, a bank that services institutional investors. And the people who own the customer relationships in that world are usually the asset managers. The asset managers, or perhaps the wealth managers. You don't face, the marketplace does not face the individual consumer, very rarely. Only through retail distribution platforms like Hargreaves Lansdown, perhaps through St James's Place, neither of which, frankly, have had a very good time of it recently if you've been reading the press. But I want to paint for you the size of the market that needs to be disintermediated because it's inefficient in this space. Now, in the UK, I think probably £1.5 trillion of money is in deposits or in cash, right? £1.5 trillion of mortgages we have £9 trillion of long-term savings. The size of the market dwarfs any and every other. Sadly, that £9 trillion is almost exclusively held by anybody who is above the age of 35, and below the age of 35, hardly anybody has any of it because they haven't got engaged with that sector yet. If you haven't got a pension fund or a long-term savings product yet and you're under 35, get started now, is my advice. And I say that because this is my area of expertise. I worked for the FCA on the market study for asset managers for 2 years. The size of the market and the size of the problem is enormous. That £9 trillion is inefficiently serviced by a suite of counterparties that have closed networks to the tune of some £180 billion a year. Of what, that £180 billion, only about a quarter of that, and this is hard numbers, no one else has got these numbers. I have a company that specifically collects large amounts of this cost and performance data. That £180 billion, about 25% of it is paid to asset managers for the job of making decisions and executing those decisions about what to buy and sell. Everything else, £135 billion, is paid out of your money to service inefficient infrastructure. Now, the reason why I got excited when I first learned about the Estonian digital architecture is there's a company in Estonia called Funderbeam, And Fundareem operates a closed network that does T0 clearing and settlement at zero cost. Now that's a kind of complicated way of saying we can buy and sell things which aren't cash between a peer-to-peer network using a distributed ledger with zero cost and zero time differential. You find the person, you discover them, you buy, you sell, you trade, and the Estonian depository is updated immediately. In every other market, that can take between T+1 for cash, 1 day, to 120 days if it's an OTC derivative or an illiquid asset. And that's how inefficient it is. And that inefficiency costs the consumer £135 billion a year. That's the size of...
Think of all the fixed income market.
Correct.
Like that, or mutual funds.
Well, that's right. So if you ask the question, what is the business case for what we're talking about here, distributed ledger, blockchain, the whole essence of this conference, that marketplace is the epitome, the perfect description, the perfect marketplace. Inefficient, highly intermediated, closed networks with manual intervention all the way through it. Has anybody here ever seen a fax machine? Put your hand up. Have you ever seen a fax machine? Yeah, so not all of us have seen a fax machine. If you want to see hundreds of fax machines, go to Luxembourg, because they receive order instructions from wealth managers to buy and sell funds using fax machine, and they will accept no other instruction other than a fax.
And by the way, Chris, Calastone, which is a UK
I know Calastone, yeah.
fintech, right, is actually in the administration of the mutual fund industry.
Yeah, I wouldn't call it a fintech anymore, no. I wouldn't call it a fintech, but that's fine, yeah. They're part of the institution now.
Is this because the people who are making all the money and having the closed network, is it down to the people who are resistant to having the technology come in and help? Sorry, Efi.
Dominic Hobson, who chaired the panel previously, did a piece of work. He's an expert on the custody world, and I got to know him, 15 years ago when he was a journalist. He ran a big journal called Global Custodian that used to pick under the skin of custodian banks and brokers. Did a very cool piece of work about 4 years ago, which said, if a global custody bank, we're not going to name it, but it's a typical one, and by typical he means Bank of New York Mellon, JP Morgan, State Street Global Advisors, there's only about 3 or 4 super large custody banks. If they implemented an efficient infrastructure, by which he meant distributed ledger, across their entirety of their global business, they would save £6.5 billion a year in cost by taking out inefficient intermediation and people. But they would lose £13 billion of revenue as a result of a loss of their private markets. Where's the business case for them? I don't want to change. I'm going to lose net £6.5 billion of profit.
Right.
So no, I'm not going to change.
So basically all the securities, financial securities business, right, is not owned by the big tech, not threatened by
Absolutely, 100% not.
Exactly. But it's owned by this oligopoly of incumbents,
Yep,
right?
absolutely.
And it's not a technology issue, it's just this.
It is a technology issue, and the fact that technology is the answer to it, but the thing you have to overcome isn't a technology problem. It's a social problem, it's an oligopolistic problem, it's a private markets problem, I'm very happy with the status quo, I'm making lots of money, by which they won't say, I'm making lots of money, they'll say, we're returning lots of value to our shareholders. That's the phrase.
But what about if regulators come out with some regulation like PSD2 that obliges the market to implement this technology and open up? That's one question, whoever wants to answer. And I have another one because we are running out of time. What do you think is the possibility that some big tech company like Apple or Samsung or whoever launches a phone or a tablet, a technology that is powered by blockchain and allows, this self-sovereign identity, self-custody of your digital assets, be it, your identity or whatever it is. Do you think that's a possibility in the next 5 years? Why not?
Why not?
I'll answer it if you like. I'll have a good answer. And the answer is, in any kind of network like that, the most important thing is making sure the person in the network is the right person. So in Estonia, the checker of the identity. I keep looking at you, I'm sorry, but I love Estonia, great place, and that's why I married someone from there, but didn't marry you, not you, no. So the most important thing is the organization that does the checking of the identity and allows you in the network in the first place, right? That is the network can be perfect, but if you've got a bad actor in there that has been certified as being reliable, that bad actor can do what it likes, and everyone will know what it's done because it's written in the block, right? It's written in the chain, you can see it. Can you stop it? No, because they have the right to be inside the network, and every identity in the network has to make its own decisions. So the point is, as soon as you're in the network and you're a bad actor, it's a happy day, right? So the responsibility is to check who's coming into the network. And the last time I looked, it's bloody easy to create a fake Facebook account, Google identity, LinkedIn page, the ability for these organizations to confirm and check, and the desire for them to check your identity is extremely limited. And the organizations that do that checking, I'm sad to say, other than state actors, passport offices and the police, the ones who do identity checking best are banks.
Okay, so but Chris, you're building on the existing web, and maybe, you know, we have to wait for Web 2.5 that Jamie spoke in the morning, or Web 3. I want to hear from everybody else before we close their opinion.
Yeah, apart from the banks, I think telcos are also very good with the ID management these days. They are front runners. Other than the government authorities. So about the possibility of Apple or Samsung bringing in the wallets and all that, wallets already we've been using, and I think I trust more that wallet of Samsung or Apple rather than of a new startup. Again, it's a kind of a retail thing. Our trust is the same issue. So in 5 years, maybe even earlier, these big giants will be coming into this scene as well, this space as well.
We established earlier that only half the audience has a wallet. You established that earlier. So
Has a
wallets
mobile wallet? Only
So
half?
it was only half, yeah. So it's time
As in a physical wallet, yeah.
leather bound. Time for that to catch up with things as well. I think it's possible. I think we need to look also right in front of our face. You know, post-trade settlement, or trade finance, or supply chain finance. We're always talking about SMEs now because they're the largest contributor to most economies, and yet they get pushed out most of the time because we can't do real-time valuations of goods. We can't do pre-approved lines. I mean, there's some immediate applications, I think, for the technology, but I never say never to something that could happen in 5 years with the big tech players.
Yeah, I think recently LG and Samsung just formed an alliance to open up a blockchain research center. So they're definitely moving towards that. Japan, they also have a self-regulating digital asset alliance. I think Coinbase just recently joined that. So there are definitely, the players are definitely pushing towards that. And I think I think in the space particularly, there's the revolutionaries, and then there's the big players. I like to call myself the most compliant revolutionary, because I believe that needs to be a conversation. For this to actually happen, the regulators who don't really know anything about technology for the most part really need to be speaking to the foundation, speaking to the think tanks directly and intensively, because they're going to be making regulations for things that are already outdated or they don't understand.
In support of the UK regulator, they're very good at it. The FCA is very good at working with fintechs in the UK.
Right, in the sandbox, and in what, 2 years ago, blockchain was the flavor in the sandbox. This year, it's regtex. Right?
Yeah, absolutely.
And what is really a regtech? So, you know, the 6 areas.
So shall we wrap up saying that there's a lot happening in a sandbox form, right? And it's more probably geared to SMEs and the supply chain use cases, rather than expecting to see something in retail banking before.
If I see another payments app, peer-to-peer platform, crowdfunding platform, supply chain finance, I think I'm going to lose the will to live. What I really want is this. Yeah, that's right. And the issue I have there is that the market you're attacking is tiny, but you've probably got a chance of succeeding, so maybe you should go for it. But if you want a really big problem, you want to really make a lot of money and you want to really make a difference, hit that 135 billion pounds a year in efficiency. Because even if you take 1% of that away for yourself, that's 1.35 billion. You've made more than any other fintech out there. And guess what? You return 135 billion pounds of value to the consumer every year. So I'm going to tell you what that means. It's 1% of assets per annum uplift in the performance of a pension fund. And over 47 years, the size of the pension fund doubles.
Thank you very much. I hope the audience enjoyed.